Welcome back to the Ameritrade Network. It's time for some overlooked stocks. George has three on his mind. One of them connected to cloud. Let's start there as we're watching Salesforce get hit. George, you've got ZENDESK on your mind, which is a customer service software among some other things that they supply. But it still is in that category of cloud. And Salesforce is getting punished here. So should we be watching this group for overall pressure?
I think so. I think you brought up a good comparison right off the back. I mean, ZENDESK, which was founded in 2007, is actually an interesting company. It's a unified communications as a service company focused on customer service. So it's a software data platform that unifies and simplifies customer service across multiple engagements. And we've, if you've ever tried to call your cable company, it's nearly impossible. But we get a live agent via chat, self-service, phone, messaging, and email, aside from, again, a live person. So ZENDESK has software that helps manage these applications across multiple platforms. But they do compete with Salesforce.com. Other competitors include Oracle, SAP, which is the German equivalent to Oracle. But this is a company that's interesting in the sense that it's still not profitable on a consistent basis, and it's up considerably today. So it kind of caught my attention as to why, but one of the reasons today was that there was an insider, not sort of insider, but major shareholder firm, Jana Partners, which I'm sure you're familiar with, actually voted down a October acquisition of SurveyMonkey. Now, SurveyMonkey is one of these companies that does customer service surveys, designs them and issues them, and of course aggregates the data and disseminates data from an analytical standpoint. Now, this was a $4.1 billion acquisition, quite large, I think, relative to the market cap of ZENDESK, about $12 billion. This is back in October, late October, so about a month or so ago, and the stock actually fell about 16% as a result of that acquisition news. And I think today we're seeing the unraveling of this acquisition based upon shareholder majority votes, which looks like they're going to shoot down the acquisition. That's why we're seeing the stock higher today, at the very least, in a market which is pretty nasty because of what Jay Powell said earlier.
All right. So, George, right now, cloud is the opposite of a ZENDESK. It's kind of chaotic. Georgia, what do you think will determine whether or not this group finds any relief from the past week? If ZENDESK going lower, the whole group, as we see, looks like that chart. ZENDESK is a dramatic one. It's definitely one of the weakest trends out there in the space. But when we start to see the stalwarts and those with the biggest moat get encroached on as well by the bear camp, what's to stop it? I mean, are we going to see just any growth rate here not be enough for investors at this point? Because it seems like that's what's going on with Salesforce, because there's nothing really wrong in the earnings.
Yeah, that's the thing. I think there's less appetite right now in this market environment for technology stocks, OJ, especially growth-centric ones like ZENDESK. I mean, overall, we've seen better in terms of performance, sales-wise, growth. Last quarter was about 32% year over year, but net profit margins, negative 16%. So we talk about the rule of 40. You got to see the summation of at least, if you're not making money or your profit margin is negative, you have to offset that by at least 40 plus summation percent net increase when it comes down to revenues minus your losses, and we haven't seen that with ZENDESK. Now, based upon the news, we could see some momentum continue to the upside. I think overall it was a big bite to take on, or too big of a bite to chew for ZENDESK, and that's why the stock fell considerably. But I also think the stock was down based on multiple compression. There is no appetite. If you look, not just ZENDESK, but across the spectrum of growth stocks that aren't profitable, they're just terrible. If you look at the Russell 3000, the stocks that are hitting new 52-week lows, they're actually increasing. And most of these are these non-profit, profitable-based growth companies. Not necessarily just pointing out ZENDESK, but there are a lot of companies in the Russell 3000 that are down considerably. So I think the appetite for low profit companies, interest rates that are rising, inflation concerns, and now you've got a Federal Reserve that acknowledges these concerns. I think right now the appetite for any technology might be a little bit stretched because this market seems a little bit iffy in terms of finding some footing, which again is very challenging as we move into the end of the year.
Okay. All right. So, George, let's keep going with the planned agenda here. I know we could keep talking about what's happening in this group because it is very important, I think.
Yeah.
But you've got a few others on your mind here. And both these stocks have had giant upward moves in the short term. Let's go to an industrial theme. Pioneer Power Solutions, electrical transmission, distribution, and on-site power generation. This is like those stocks that love it when there's hurricanes and stuff out. How come it's doing so good right now?
Yeah, I think a couple of reasons, OJ. If you look at Pioneer Power Solutions is the company, by the way. This is a small industrial company focused on electrical equipment. It sells in services, and services is a key component of its revenue base. Monitoring service for its hardware, which is like switchgear and things like generator controls and customized on-site transmission and transformers for backup power. They call it critical power solutions segment of their business, along with their monitoring services, which monitors the power itself. So I think overall, we're seeing the evolution of a secular trend when it comes down to on-site power management, and that seems to be a trend that's going on. I think if you look at the industrial space, whether it's hospitals or even data centers, there's demand for critical solutions, power solutions that, of course, Pioneer Solutions provides the marketplace, but also on a customized basis. Companies like Generac, they do have a customized service and solutions-based division, but in terms of its scalability, it sells very uniform products. Now, Pioneer may have a challenge because of the fact that it sells very customized power equipment to individual customers. But at the same time, it's got some recurring revenue business associated with servicing and monitoring their power demand needs. So I think what we're seeing is sort of a twofold thing going on. One, the stock is mentioned as a small cap sort of momentum play, only 80 million in market cap, but it did generate about 20 million in revenue last year. So it's only trading around 4 times sales. At the same time, it reported earnings on the 16th of November, and also it looks like it hit in the pre-market about $13, but it didn't effectively close above those November 8th highs around 1050. So it might be pressed to the downside as a small cap mover. Today, it didn't actually breach and close at least on a couple of consecutive days above 1050, so that might present some challenges. But I will say this, the company itself is not profitable, it's very low gross margins. It is a momentum play because anything less than $100 million could easily be tossed around by retail traders, and I think that's one of the reasons why we saw it higher today in a market that was down.
All right. Okay. So PPSI is getting quite a bit of action here over the last couple weeks. Big move, earnings that really put major fire under the stock and holding up near those highs, 32.5% off the highs of the day, top highs that we got to above $12. But all right, pretty close to the record. George, one more that's also connected to COVID. VIR Biotechnology, VIR, the ticker, picking up a little bit, and an analyst upgraded it. Is there an expectation that their pipeline for COVID treatment might work for this latest variant?
This one's interesting, OJ. Yeah, we talked about some of these antibody-based therapeutics, and I think that's where a lot of the COVID dollars are going. They're going into therapeutics because, again, there's apprehension for many people to get vaccines and so forth. So there's a big market for therapeutics, and I think with these variants, companies like VIR Biotech may have some promise. Now, this is a clinical stage company. It focuses on 4 technology platforms from a standpoint of therapeutics. Antibodies is one, and that's, I think, one of the key reasons why the stock has been higher. T-cell therapies for cancer, innate immunity, that's another sort of COVID tie-in, but also RNA therapeutics, which we know the vaccines that are out there are RNA-based, which seems to be the trend in vaccines. So I think overall it's got a pretty aggressive pipeline of products, but I think overall, if you look at the company itself, it actually is still in a pre-stage trials for all of its drugs, but it does have partnerships with major players. In fact, biggest partner is GlaxoSmithKline. The other thing is one of the things about its treatment is unique, and we talked about other companies that focus on people who are critically ill from a respiratory standpoint, and they're doing better. Where if you look at VIR, their antibody technologies and drugs, which haven't received FDA approval, by the way, I will say this, have shown effectiveness for early stage now. This is an early stage medicine for those who are essentially non-hospitalized with COVID-19, and those, again, with mild to moderate symptoms. So this, again, targets a very different market than, let's say, terminal stage illness. But at the same time, looking at partnerships, the revenue base relative to market cap, the company's market cap is $6 billion, and it generated about $250 million in revenue last year. And particularly, if you look at quarters 2 and 3 of this year, it generated a pretty significant number of revenues, $103 million, whereas last year for the same quarters, it only generated about $70 million.
All right, so a nice improvement, moving in the right direction. Stock starting to wake up, moving in the right direction too. All right, so we'll put it on our list of not necessarily also RANs, but currently running as COVID treatment stocks.
It is. And I think if you look at the number of analysts that cover the company, OJ, that's why I say it's interesting. Everyone has to do their own research and do their own due diligence. But 8 analysts cover the company. There's a $68 consensus price target. Now, H.C. Wainwright aggressively upgraded the stock to $200 from $135 today. Now, this is one small analyst firm. But at the end of the day, I went and looked at the balance sheet of the company, and it's got about $935 million in cash. And it only lost about $150 million last year. So it looks like it's very cash rich, and that's about 18% of the total market cap. So that effectively is a theoretical floor on the stock, the cash on the balance sheet. So again, a couple of the things to mention, or one other thing I will say is that the Japanese Ministry of Health has already approved the medicine for special needs use. This was back in August, and so did the equivalent authority in Australia. So it already has special approval, even though it's not necessarily FDA approved for treating COVID-19. It has been used, their drug now, in conjunction with GlaxoSmithKline's distribution and manufacturing in both Japan and Australia. So I think it's one to certainly keep an eye on, but everyone has to make their own decisions and do their own due diligence.
All right, nice, George. At least you could do is put it on our radar so that we know which one to look at to make those decisions. Overlooked stocks, George Tillis living up to the name again. Thank you, Mr. T.